On a $700,000 home, a 5% deposit can leave you borrowing $105,000 more than the 20% path. The small deposit gets all the attention because it feels like the key to the front door. But the larger loan is the part that follows you through it. If you are wondering whether to buy sooner or save longer, stay with this. We are going to separate the genuine help from the headline, compare the two paths, and finish with 5 questions you can use before you make an offer. The feeling is familiar. You have saved for years, you are tired of moving rentals, and every inspection makes the deposit target look like a train leaving the platform. A 5% deposit feels less like a financial setting and more like permission to finally start. For eligible buyers, the government scheme can help a lender accept a smaller deposit without charging lenders mortgage insurance. That is useful. It can lower the cash wall before settlement. But it is a guarantee to support the lender's risk, not a pile of extra money added to yours. The useful saving is the insurance cost you may avoid, not a discount on the loan balance. That difference is easy to miss because the deposit is visible and exciting. The debt is quieter. It arrives later as a repayment that must still fit beside everything else your household needs. That means the house does not become cheaper. The interest does not disappear. Conveyancing, moving, repairs, and the first surprise bill do not become someone else's problem. The scheme changes how much deposit you need. It does not change what owning the home asks of the household. There are also ongoing obligations. The home is meant to be your home, and the scheme has rules that need checking with the participating lender. That matters if your plan is vague, like buying now and renting it out soon after. A good plan can survive the paperwork. A rushed one usually cannot. General information only, not personal advice. But here is the household version of the maths. The question is not whether the bank will lend the money. The question is whether the loan still leaves room for groceries, a sick child, a car repair, or one ordinary month that refuses to behave. That margin is what we mean by breathing room. It is not a luxury category for a perfect household. It is the space that lets you pay for a dentist visit, take unpaid leave, replace a tire, or say yes when a family member needs help without immediately reaching for more credit. On the same $700,000 home, the 5% path starts with a $35,000 deposit and a $665,000 loan. The 20% path starts with a $140,000 deposit and a $560,000 loan. Same front door, very different amount of bank money sitting behind it. The difference is $105,000. That is not an argument against buying with 5%. It is the number that stops us calling the choice a shortcut. You may be buying time, stability, and control over your home. You are also choosing a longer relationship with a larger balance. That relationship can still be worth choosing. A renter facing frequent moves may value certainty more than a larger starting equity position. Someone with a stable job and a modest property may be comfortable carrying the extra balance. The point is not to shame the choice. It is to name what the choice costs. At a hypothetical 6% over 30 years, that example is roughly $3,987 a month on the 5% path and $3,357 on the 20% path. The gap is about $630 every month. That is where the deposit decision turns into a life decision. People often compare a small deposit with a large deposit, then stop there. We think the better comparison is this. After settlement, do you have a home and/M enough breathing room? Or do you have the home, a proud photo of the keys, and a bank balance that now feels like a fire alarm? Waiting is not automatically safer either. Saving the extra deposit can take years, and renting can feel unstable or exhausting. For some households, buying a modest place earlier is a rational choice because it creates security now. The point is to price the trade-off honestly, not pretend one path is morally better. Waiting has its own pressure. It can mean another lease decision, another move, or another year of putting off changes because the home is not really yours. A low deposit purchase can make sense when it solves a real housing problem and the monthly plan is still solid. The two conditions belong together. There are 3 things the scheme cannot buy for you: emergency cash, time, and a comfortable repayment. A guarantee can help with the entry barrier. It cannot create a buffer after settlement, stop a family change, or make an overstretched property suddenly fit your income. So pause on this privately. If the property price did nothing exciting for the next few years, would you still feel okay keeping this home? Not thrilled, not rescued by a prediction. Just able to pay, live, repair things, and let time do some of the work. This is a deliberately unglamorous test. It does not ask whether the home will look impressive online or whether a headline will make you feel clever. It asks whether your plan can handle a boring stretch. The boring stretch is often where a sensible purchase proves its value. Negative equity is the uncomfortable situation where the home is worth less than the loan against it. With a small deposit, there is less room for a value fall or the costs of selling. It becomes especially painful if life makes you sell or refinance before you have built equity. That is a risk scenario, not a prediction that every buyer will be trapped. Recent reporting made the sensible distinction. Low deposit borrowers are more exposed if prices fall, but the biggest problem is usually needing to exit early. The useful question is whether your plan leaves you choices. Think about the exit door before you celebrate the entry door. Could you stay if work changed? Could you cover a repair? Could you hold the home through a slow patch? A smaller deposit is much easier to carry when you have time, income stability, and cash still sitting beside the loan. Refinancing is another reason to think ahead. It may be useful later, but it is easier when the loan and property value leave the lender comfortable too. We would not build a first home plan around a future refinance saving us. Treat it as an option, not as the emergency exit. APRA says the mortgage serviceability buffer remains 3 percentage points. Banks use that kind of stress test because the advertised rate is not the only rate your household may ever face. Passing it matters. But a bank's model cannot fully see your parents' health, your childcare plans, or your broken washing machine. This is why the better home may be smaller than the maximum you can win at auction. A unit near work, a townhouse with lower maintenance, or a less fashionable street can be a stronger first step if it leaves room for life. The goal is not to impress the spreadsheet. The goal is to keep the home. Sometimes the safer property is not the flashiest one. A shorter commute can protect time and transport costs. A smaller garden can protect weekends. A building with predictable upkeep can protect the buffer. These are not tiny lifestyle preferences when the loan is large. They are part of the affordability decision. Before you bid, separate your money into 4 piles: the move, immediate repairs, regular ownership costs, and an emergency buffer. If all the cash becomes the deposit, the home starts asking for money before you have recovered from buying it. That is a stressful way to begin something meant to feel secure. The common trap is not using the scheme. The trap is letting the scheme talk you into your maximum price. A smaller deposit can turn not enough cash yet into we can bid today. Those are different statements. Only one tells you what the repayments will do to your ordinary Tuesday. Choose a walk-away number before the auction energy begins. It should be based on the repayment and cash left after settlement, not on how much another buyer seems willing to risk. Walking away can feel disappointing for a day. Buying beyond your buffer can feel disappointing every month. Here is a better offer rule. Do not ask, can we get approved? Ask, does the payment work? Does cash remain? And could we stay if we had to? If one answer is no, the answer is not necessarily never. It may simply mean a cheaper property is the smarter version of yes. Question 1. Can the repayment work from normal income? Do not make the plan depend on overtime, a bonus, a tax refund, or the heroic version of yourselves that somehow never gets tired. A home loan should survive the boring version of life because that is the version most of us actually live. Question 2. What cash remains after settlement? Not what you hope to save next month. What remains after the deposit, the professional fees, the move, and the first jobs that appear when you own a place. A buffer is not boring spare money. It is what keeps one surprise from becoming a decision crisis. New owners meet the first repair quickly, even in a well-kept home. It may be small, but it changes how the budget feels when every dollar has already been allocated. Leaving cash aside is not pessimism. It is how you stop a normal maintenance job from becoming a credit card story. Question 3. Could you stay for several years if needed? A low deposit purchase is easier to live with when you are not planning an immediate escape. Time lets repayments do their quiet work. It gives the household a chance to build equity instead of needing every market movement to cooperate. Of course, life can change even when you plan carefully. Jobs move, families grow, and relationships shift. The test is not whether you can predict every change. It is whether the purchase gives you enough flexibility to respond without being forced into the worst possible timing for a sale. Question 4. Have you included the boring costs? Rates, insurance, maintenance, and strata where relevant arrive whether the mortgage rate changes or not. They are not reasons to fear ownership. They are reasons to make the budget look like the home you are actually buying rather than the one in the advertisement. Question 5. Are you borrowing for the home you need or for the maximum house you can win? The answer might be a smaller place in a better routine with lower pressure and more choices. That is not settling. It is designing a first purchase that your future self can still afford to like. Try describing the home through an ordinary week. How far is work? What will maintenance ask of you? Can the rooms handle the next stage of your life? When the answer improves your routine as well as your balance sheet, a smaller first home can be a genuinely bigger win. Now the 5% scheme has a clearer shape. It is a bridge when the deposit is the last barrier and the household can carry the bigger loan. It is a warning sign when the smaller deposit is hiding a price that leaves no cash, no flexibility, and no way to breathe. That conversation can feel less exciting than looking at listings, but it is where confidence comes from. If the plan survives an honest discussion about income, repairs, and time, the scheme may be doing exactly what it was designed to do. If it does not, the property price, not your ambition, is the thing to adjust. Tonight, write down the property price you are considering, the repayment at that loan, and the cash you would have after settlement. Then answer the 5 questions without trying to win an argument with yourselves. If the numbers are tight, reduce the price before you reduce your peace of mind. The best first home is not the one that makes the biggest announcement. It is the one your household can keep living in when life becomes ordinary again. Keep the questions, keep the buffer, and let the headline deposit stay in its proper place.